Improving our average. All right, there are all kinds of funky things that price action can do to try to trick us out of our trade position. It can move into consolidation that can be confusing. It can break a support level, stopping people out who had their stops just below it, just to have the market reverse higher without them, and the list goes on. So what I like to do is break my trade into 2 or 3 parts and take a quick profit on the first push in my direction. What this does is it improves our cost average and reduces risk without having to move our stop. Just as we can expect the asset to move against us, we can also expect it to move in our favor quite often. So just maybe not all the way to our final target, right? If we have entered the market in a good area, even if the trade as a whole doesn't work out, we can usually expect an initial push in our direction. Unless your entry is just absolutely awful, that generally is the way that it works, right? If you've given your trade enough room to breathe with your stop location. So what it looks like. For example, we buy 3 futures contracts that move 1 point in either direction, right? Our stop is 6 points below our entry, which would be a total risk of negative 18. We hold 3 contracts, we're down 3 points for every 1 point that moves in our asset, and vice versa. That's how the math works, right? So price moves up 6 points, and instead of moving our stop to break even, which will almost certainly cause us to be stopped out, we instead close 1 contract with a 6-point profit, right? So now what is our risk? Contract 1, we have is negative 6, right? Contract 2 is negative 6. Contract 3 is positive 6, right? So some basic math shows us that with an initial risk of negative 18 points in the beginning, taking 1 small profit can move our total risk down to just negative 6, right? So at that point, we've done our job protecting and reducing our downside risk, and now we can focus on the upside. So there's also nothing stopping us from adding that 3rd contract back on where it makes sense if the trade continues to work in our favor. So some people say that you are killing your potential gains by doing this, but as I've shown, reducing risk and remaining flexible are critical. Though this is something that you must explore personally and find a good fit for you. So when we go later and we break down back testing and forward testing our strategy, this is going to be a metric that we're going to want to keep track of. And based on your strategy, you may find that this either works or doesn't work for you. But what it does is it most certainly, again, it improves our average. It improves our cost basis so that shortly after, when we get a little bump up in price, or, if let's say we're going long, right? We get a little move in price, we take a portion of our trade off. It completely changes the game as far as our risk is involved and for the rest of the trade, right? So it does a few things, right? When you take an initial profit off, it gives you a bit of that relief to go, okay. We've popped some money in the bank, right? So that feels good, right? Not that we're not trying to run on emotions, right? But again, we're not robots. And so for some people, this has an added effect of just being like, all right, cool. It's like it can pump you up in the trade and just kind of give you that little confidence boost. Like, all right, cool. Things are moving in my direction. Took a little bit of profit. Took a little bit of risk off the trade. I've improved my average for the rest of them. So now there's essentially no incentive. There's essentially no incentive to make any more to make any additional mistakes, right? I mean, we're really trying to just game the way that our mind works until it becomes a habit. But sometimes these things, just no matter how long we work on them, we still will struggle with them to a small or minor degree. And at that point, we're just trying to figure out ways around how our mind is geared and see what we can do to work against that. So this is an example of something that you can do to essentially bypass, hack your mind, and it also is really, really effective at reducing the overall risk of the trade. All right, so let's talk about this though. So reducing risk or reducing anxiousness. So sometimes people do things that make it feel like they are protecting capital or reducing risk when they are actually only hurting themselves, right? So this is the other side of the coin with what I just mentioned. So we enter the trade with a well thought out plan, And our job is to give that trade every possible chance of working out. So it makes no sense to move our stop before the trade has developed because we are trying to reduce our risk of loss, right? So this is how that's different, right? This is ineffective where the other one is much more effective on multiple levels. So by moving your stop into the range of current price action, you dramatically increase your chance of getting stopped out. And then you get to watch the asset move to your profit targets without you, which is no bueno and always sucks, right? So now instead of having a buffer of profits for the next trade that is a loss, your account will be negative. Keep doing this and it's a sure way to blow up your account. So trying to keep your risk at zero by moving your stop and only staying in if things move immediately in your way sounds great, but does not work in the real world. We must make sure that everything we do is backed by solid reasoning and hard data, not just placating to our emotion or security. So what I've done is, this is a tendency for new traders to do. I've explained to you why it doesn't make sense, why you shouldn't do it, especially now that I've given you an example in the previous slides of how to improve your average, how to take a quick profit hit, quick dopamine hit, as well as reduce your risk and leave your stop alone until it's time to move based on market structure, based on these other metrics and stuff that we'll go over in the future.